welcome back to the vlog. This is going to be reading number 2 for me today. I think it's a good day to do 2 readings. So let's just jump right in. I want to get the information. I'm happy. I just want to trade. Everything's all good. Let's go. So we ended on applying stops to adjusted positions. And so we're going to jump into managing your trade like a pro. Okay. So every indicator and set of indicators generates a gain-loss profile. The next task in becoming a fully qualified technical trader is to apply the gain-loss profile of your indicator or indicator set to your own specific circumstances, namely how much capital you're going to put into trading and how many trades you can execute. These sections help you perform that task. Introducing positive expectancy. The only reason to make a trade is that you have positive expectancy of making money from it. We're not gambling. Expectancy is a mathematical construct that can get very difficult very fast if you let it. But the basic concept is easy enough. You add up the possible outcomes and average them. Here's an example. Pretend your indicator set would result in a 90% chance of a 50% gain and a 10% chance of a 100% gain. To put that in a formula, looks like this: expected return. I'm just going to show you. I'm not going to read out this mathematical equation. I'm approaching. Boom. And we're right back at it. Next. All right. So where did those percentages come from? They come from your having looked at your indicator or indicator set over some past look back period, because you're a scientist, and written down every gain and every loss and calculated the percentage of times you got each outcome. You've read up on all of the indicators and selected the ones that you like and feel you can handle. You have either eyeballed those indicators on a chart of your favorite security, or my apologies, my alerts are going off for Ethereum. Let that pass. All right. You have either eyeballed those indicators on a chart of your favorite security or back tested them to verify the number of gains and the ratio of gains to losses. The important point is that the expectancy is positive. It would be foolish to make a trade that you expect would result in a loss, right? Simple. And yet people do it all the time on the grounds that the stock is sure to be a winner in the long run because of its fundamentals, tech or pot stocks, for example. Measuring the trade. Measuring your gain-loss numbers correctly isn't all that hard, although it can be time-consuming. Don't worry about applying formulas. The following formulas are logical and use only the arithmetic you learned in grade school. The following formulas are logical and use only the arithmetic you learned in grade school. Fair enough. To get the numbers to fill in the formula, follow the steps below. Notice that it doesn't matter which indicators you put into your indicator set. It can be one indicator or any number of combinations of indicators. To see a discussion of combining indicators, see chapter 16. This section isn't about indicators, it's about measuring the trades that results from the indicators. All right, so number 1, calculate your win-loss ratio by adding up every winning trade and every losing trade over the past year. Yes, year. If you're here, I hope you're in this for real. Year. Moving on. Whether from your real life trading or your back test. And then divide the winners by the losers. So this also would require that you're writing your trades down, that you're documenting. You can't be a scientist if you don't document. You can't be a scientist if you're relying on your memory to remember what the results were from literally dozens and hundreds of trades. It's just not realistic. You must write these things down. All right, 6 months might be okay, but not less. Remember, you need a sufficient number of experimental trials to be able to deduce anything, as I described in chapter 2. Say you're trading either real or hypothetical from the back test generates a win-loss ratio of 2 to 1, meaning a $2 gain for every $1 loss. This is pretty good, right? Yes, but it doesn't go far enough. The win-loss ratio doesn't link the gains and the losses to the amount of capital that you put at risk, and doesn't help you figure out the expectancy for the next trade. Maybe you made one trade in the year that netted $200 on a capital stake of $10,000, and one that lost $100 in the same year on the same $10,000 trade. You still have a 2 to 1 win-loss ratio, but the rate of return on capital is tiny and the frequency of trading isn't high enough to deduce expectancy for the next trade. Number 2, measure the expectancy. You need to figure out whether you can have positive expectancy about the next trade using your indicators. Use this formula. Average profit per winning trade times winning trades as a percentage of total trades minus average loss per losing trade times losing trades as a percentage of total trades. Don't panic, I'm going to show you right now. Okay, so the portion that you may want to just simply screenshot here is right here, okay? So you would average profit per winning trade times winning trades as a percentage of total trades minus average losses per losing trade times losing trades as a percentage of total trades. Right there. Screenshot that. So say you find the set of indicators that would have generated this profile. Okay, expectancy on indicator set 1. More mathematical equations. 800 times 35% minus those in parentheses minus in parentheses $400 times 65% in parentheses equals $280 minus 260 equals 20. All right, in other words, the indicators deliver a home run of $800 on 35% of the trades, but big losses on a majority of trades. So your expected gain per trade on the next trade is a mere $20. And this is why reverse engineering and being a scientist is really important. It's really important. It can look and feel like one thing, and then it's really just not. Like, this is important, okay? Okay, so back to the drawing board. The set of indicators isn't good enough. Here's the outcome from a different and better set of indicators, which I name indicator, I say I, it's not me, it's him. Yeah. Indicator set 2. The new set of indicators generated 55% of winning trades and 45% of losing trades. But the average winning trade gained $400 and the losing trades lost half that, or an average of $200 each. So expectancy on indicator set 2 would be, in parentheses, $400 times 55%, close parentheses, minus, in parentheses, $200 times 45%, close parentheses, equals 220 minus 90 equals 130. That's a lot better turnout. Using this new indicator set 2, your expectancy for the next trade is a net $130, which is a whole lot better than $20, but $130 on how much capital and how many trades, right? So considering your stake, the word stake refers to how much money you're placing on each trade. The need to add that into the expectancy formula, you need to add that into the expectancy formula because the amount per trade affects the outcomes over time. To get a handle on this idea, consider you have $10,000 to put into securities trading, but you're busy with a job and family. So you want to trade only 4 times a year, or once a quarter. Here's the question. Given these constraints, how much money can you expect to make by the end of the first year? If you use the expectancy from the preceding indicator set 2, that each trade has a high probability of making $130 and you're trading only 4 times per year, you have a high probability of making 4 times 130, which would equal $520. Given a starting capital stake of $10,000, this plan doesn't pass the so what test. The so what test asks how much money you want to make as a multiple of starting capital. This outcome is a 5.2% gain, more than a bank savings account, but not worth the time and trouble that of all that trading work. So back to the drawing board again, right? So, but you'll keep indicator set 2, but what you want to change is the percentage gain on your $10,000 stake that makes the trading effort worthwhile. Say you want to double your stake to $20,000. How many trades would you have to make to get that outcome? Well, here's the formula. I'm going to show you again. So here's the formula. Capital goal equals starting capital plus, in parentheses, expectancy times capital stake per trade times total number of trades, close parentheses. Screenshot. Boom. All right. Moving on. Okay, so if you traded the full amount of $10,000 on every trade and the expectancy remains stable at 130 per trade, you'd have to make 76.9 trades per year to double your money. I will say these numbers to me are kind of crazy. I've made like $200 in a trade using $250, like many times. So don't be discouraged by these numbers. Don't be discouraged. Like you can make, especially like trading on leverage, you can make a lot more money than this. I promise you can. I'm not even 3 years in the game, and I could do this in my sleep, damn near. Seriously, okay? So don't be discouraged by these numbers. Trading only 4 times a year won't double your money to 20,000. Given the expectancy of indicator set 2, 130 per trade, you need to execute 77 trades per year, which is a little more than 1 trade per week. The only way around this deduction is to devise a new indicator set 3 that delivers more than 130 per trade. And that's not the only issue. Notice that I haven't incorporated the initial losing trade in this example, but you know that in indicator set 2, 45% of the trades are losing trades, and each losing trade costs $200. What if the first trade is one of the losers, and you know you can expect to lose 45% on any losing trade? Your capital take is now $10,000 minus $4,500 equals $6,500. Now, you're no longer seeking to double your stake, but to more than triple it. Right off the bat, you know it won't be 77 trades per year. You'll have to make more trades to restore the total capital to $10,000. You should never put your entire capital stake on the first trade. Experts differ on how much you should put in the first trade, but a general rule is 10 to 20%. Calculating expectancy and figuring out how much money you can expect to make and lose, and how much of your capital stake to put in the trade is a tedious, complicated, and time-consuming project. You may think that you can skip this step. To calculate the expectancy and apply it to find out your money gain and number of trades needs is more about money or risk management than about technical analysis itself. Note, how many times in this book I say no indicator works all the time. You should want to know how many times it failed and how much those failures will cost you.